Welcome to Commercially Speaking, the podcast where I teach my little brother all about commercial real estate. This is my brother, Timmy. Timmy, when it comes to commercial real estate, he's an idiot.
Look what I found.
Timmy.
But it does make me think of a dog's sack.
Eric, meet my brother, Timmy. And Timmy, true to form, as normal, you just breathe energy into the equation just by showing up.
Oh, very wide 70. You like Elton John?
He says he's ADHD, but I think he's lying.
Bopped around, so we did a little bit. Italy, Greece, Turkey.
I did. Is Italy known for their greasy turkey?
Don't forget about our fuzzy little friends, right? We got the dog population will get bigger.
Do you know how dull our family get-togethers would potentially be if we took you out of the equation?
All right, Bo, what you teaching me? What are you teaching me today? Okay, Bo, what are you teaching me today? Bo, what are you teaching me today? What are you teaching me now? What are we talking about now? What are we doing right now? What are you teaching me today? All right, what you teaching me? Bo, what are you teaching me today?
What are you teaching me today?
What are you teaching me today?
Today we're going to take you through an investor pitch for a syndication deal. Timmy's going to role play, and I'm actually going to pitch the deal to Timmy.
I'm a rich guy now.
This episode is why a commercial real estate client should hire a commercial real estate agent and not their buddy who sells houses. Let's tell some stories about some unique negotiations.
Cap rates.
The most misused term in commercial real estate.
No cap.
No cap.
This is Bo Barron, CCIM.
And he's zoning out right now, but that's Timmy Barron, ADHD, actor and comedian.
Oh, are we doing that?
I'm already done with this.
And I know nothing about commercial real estate.
And I know nothing about acting. Hey, let's start over. Hey, this is Bo Barron, owner and managing director of Barron Commercial Group, and
then this is Timmy Barron, owner, and I don't own much. I'm an actor.
What's the name of our podcast here?
This is your new favorite commercial real estate podcast. This.
Oh, I just went all ADHD on you.
Say this is commercially speaking, Bo.
And this
is commercially speaking.
Commercially speaking.
Commercially speaking.
All right, let's do it. What a train wreck.
I do want to know what a broker is.
Okay.
Yeah, because I tell you what. Let me tell you my why before we're done.
Oh yeah.
The reason I'm super excited about this is because when I was a kid and in preschool, I remember this in preschool where they went around there, everyone was talking about what do your parents do for a job? And it goes around, it's like firefighter. And then when it got to me, I was like, work. He goes to work. He works at work. I had no clue, and all growing up didn't know. I know it was brokerage, but how is that different than real estate agent? You know, I know a little bit more now, but it was just all so foreign. And, you know, he just did his thing, came home and never talked about it. And I'll be asking several questions like that moving forward.
It's clear there's 120 jobs that are coming with this company moving to Owensboro.
Yes.
But what does that mean to you?
When I see a job announcement, my ears perk up. That means potentially there's going to be more demand for what I do. There's two different types of jobs, and they're not equal. So you have basic jobs and you have non-basic job. When I tell you have a basic job, that doesn't sound awesome.
No.
That almost sounds less than. When you're talking jobs, basic jobs are the ones you want. And here's why. Imagine you're on a commercial shoot like you were last week. Right? You get paid. All right?
Mm-hmm.
You leave with a check, and on your way home, you stop for coffee. What's your favorite coffee shop?
Happy Monday.
Okay, so you stop at Happy Monday, and you see your buddy behind the counter. Who's your person behind the counter?
Joe.
Joe. So you see Joe. You know Joe, and you buy a cup of coffee from Joe, and you might hang out there and do a little work on your laptop, but you spend some money at Happy Mondays, and because you do, Joe gets paid. Before he gets paid, some of your money goes to taxes. When Joe gets paid, he has to pay taxes, right? And he might save some. So now let's say $10 of what you spent ends up with Joe. He doesn't have $10 anymore. He might have $7.50 that he can go spend. And maybe on the way home, he wants a donut. So he stops at Dunkin' Donuts and he spends $5. When dollar bills are circulated within a local economy, it continues to dwindle.
Hmm.
So basic jobs are a big deal because they bring the new dollar bills in to the community.
Mm.
And if not, man, you've got leakage because of taxes and savings, and you'll have a dying community. So the basic jobs, the other great thing about them, not only do they bring the new dollar bills in, but they have a multiplier effect. So every basic job has a certain amount of non-basic jobs that it creates. And you can do the math on any community and figure out what that multiplier is. In Owensboro, the multiplier, we call it an economic base multiplier, is about 5. So 120 basic jobs, you multiply by 5, and that's actually 600 new jobs.
Mm.
And this is where this gets pretty exciting.
Now, when it comes to tax season, here's what people who have commercial real estate or invest in. And look, when I say commercial real estate, I'm talking about anything but houses. Here's what they can do. And in fact, the tax code says they should. The government allows you to do a cost segregation study. So what you do is you grab an accountant or an engineer who knows how to do this. They come in and they, on paper, deconstruct your building, take all the components of your building, and they put them on different life cycles. I think there's a 5, 10, and a 15-year life cycle, and then there's the 39. This is a retail building, so it's 39 years. So what that means is, right now, if I don't do a cost segregation study, I take the value of the building minus the land, divided by 39, and that's what I get to depreciate every year.
Mhm.
If I do the cost segregation study, then some of that value is going to be removed from the 39-year schedule and put on a 5-year schedule. So let's say $100,000 gets moved from 39 years to 5 years. Now all of a sudden, that $100,000 divided by 39 was going to be something small. $100,000 divided by 5. Now I get to depreciate $20,000 a year. So after the cost segregation study, it moves a lot of that value onto these schedules that allow you to depreciate faster. I'm not getting to depreciate more than what I paid for the building, but I get to depreciate more of it up front. So let's say I made $100,000 in a year, and because of my commercial real estate investments in the cost segregation studies, I get to depreciate $95,000 in a year. My taxable income would be $5,000.
Wow.
Wow.
Future.
Well, in my opinion, cap rate is the most misused term and misunderstood term in commercial real estate. People misuse this thing all the time. So let me share with you what it is. I don't know what the book definition of capitalization rate is, but here's essentially what it is. You buy a property for $1 million. Let's say it produces $100,000 in net operating income every year. The cap rate would be 10%. You take the net operating income of a property, divide it by the value, and it tells you what the cap rate is.
The value that you paid for it?
If you're figuring out the cap rate when you buy it, then it is what you're paying for it. If you're figuring out the cap rate for 5 years in the future, then it would be what the value is, because there might not have been a sale.
Sure.
But it's the current value of the property. I'm sure there's exceptions to this, but it's basically just talking about that year. So think of it this way. How much would you pay to capture that $100,000 in rents?
How much would I pay for that building to capture $100,000 in? You're not saying rent?
Rent's really not the right metric, because net operating income, that's the metric you use to figure out cap rate. What net operating income is it's all the income that the property generates.
Rent being one of those.
Rents it's the revenue and all the property specific expenses that building has. Property taxes, insurance, utilities, maintenance, contract labor. What you don't include are the owner specific expenses, like, is there debt on the building? If there is, the owner is paying a mortgage payment. That's an expense that has nothing to do with the building and everything to do with the fact that the owner went and got debt. That's essentially what net operating income is. The cap rate is just, what's that percentage? It kind of gives you a feel for what's the risk of the property.
Bo, why don't you teach me how someone would go about doing their first commercial real estate deal?
All right. I think there's 4 or 5 ways that I can think of, and I'll just kind of name them and then we'll go through them.
Okay.
One is you just pay cash. All right. You save money, you pay cash. Next, you use financing. So you just like buying a house, you'll bring a down payment to the deal, you'll finance the rest, and then you buy something. All right. Another one is you can get like a money partner or a silent investor, and a lot of times they'll bring the down payment. You can finance the rest. Or maybe they just do the whole deal. They bought equity in the deal. They're an owner. And then you can do a syndication. You basically put a group of investors together and do a deal. And then the last way, and this is actually how I did my first deal. I'll tell that story in a minute, but you go borrow the down payment and then you go get financing from a bank for the rest of it. And you bring 100% debt to the deal.
I'm super excited about today for one very big reason. I get to play the role of an investor.
I didn't pitch anybody with a Def Leppard t-shirt on,
Yeah.
but I do like Def Leppard.
But I could just throw a jacket on and, hit you with a few curveballs.
All right, let's do it.
Before we jump into this, give me a few character details.
You're a local attorney, okay? So you got a thriving business. You're a high net worth individual. You love the idea of putting your money to work. You're an attorney, so you think you're very smart. You are. But we may be going into an area where you have a little bit of gap in your knowledge base. Yeah.
Do I have net worth of $1 million?
Yeah, you do.
I do. Okay.
Yeah.
All right, let's do it.
Anytime you invest or buy a piece of real estate, you want to be real comfortable with the market and the property itself.
Okay.
So we're going to talk a little bit about the market, then we'll get into the property. What's specific to this type of deal is you also have to be comfortable with me. If you check all those boxes, you like the market, you like the deal itself, you're comfortable with me running the deal, then this might be something that's a good fit for you.
Okay. Sounds good, Bo.
So the deal we're talking about here is Paradise Plaza. It's a Walmart shadow anchored. I just shared was code for Elon's just trying to do things that benefit Elon.
And it's not just Elon and Twitter, but if you look at all these major tech companies have all slashed their real estate footprints. Millions of square feet of leases at $60, $80 a square foot. That adds up really, really quick in terms of how that affects your bottom line.
We got Lonnie Hendry is 1/3 of the podcast Trapwire.
He just gave us a massive amount of context on what's going on in the commercial real estate market.
His expertise is really in the CMBS commercial market, commercial mortgage-backed security loans. He specializes in valuation, appraisals, analytics, modeling, and financial analysis.
He even shared with us a little bit about Elon Musk and what he's dealing with right now with his purchase of Twitter.
He offers me a job. He offered me a job.
But he did a great job quizzing you at the end.
But right now, I feel like the Happy Gilmore of commercial real estate.
Man, you seem to be striping it right down the fairway.
My daughter's name is Birdie, so. All right, we've got a guest that's coming in today. Bo, who do we got?
Yeah, Casey Conway. I think he's the first time I've heard an economist also kind of play that role as a futurist. So he's not afraid to tell you what he thinks is going to happen.
I was in the Fed, both the Atlanta and New York Fed, 2005 to 10, during the last real nightmare. I was the only appraiser in the history of the Fed and the only MAI to ever serve to explain to them about real estate and how it functioned. And this is a true story you'll get a kick out of. So you may go way back. So Timmy, believe it or not, before the great housing crisis, 2008 or 9, the banks were reviewed or examined on a consistent basis. One bank had been reviewed 10 years ago, another one just recently. So we had no idea how our banking system was performing. So we created this idea of stress tests. Let's stress test the biggest, largest banks every year on the same issues to see if they have enough capital. So we implemented these stress tests. So the first ones that were supposed to come out in 2009, they were supposed to come out in the fall, and they had to be stalled. And I was culpable for that vote. So if you remember in 2009, they didn't come out in 2009. We had to wait till 2010. And I was responsible for them to have to go back out there and over the holidays, re-examine and stress test all the banks. So a group of state bank examiners out of New York said, this just ticks me off. I'm going to miss the holidays. So I had to do a presentation explaining all this. And so one of them said, let's just leak it to the media and they'll put a timeout on all this and we'll do it, in the winter. So they leaked my whole presentation to the Wall Street Journal. Oh. And it was the front page of the business section. And so I'm sitting there in my Atlanta Fed or New York Fed office, and all of a sudden security comes in. They usher me out of the building. I go home, my credentials, my security credentials are pulled. I go home and I try to pull in the driveway, but there's all these dark colored Ford cars that are on the street and in my driveway. They're taking computers out of my house. They're doing search warrants. They thought I leaked it. And so it took about a month to figure out who really did leak it and to restore my credentials. And so the apology I got from Chairman Bernanke is he invited me back He said, I apologize. Would you like a bear claw donut? So Bernanke likes bear claw donuts. And when he wants to make up for something he screwed up, he invites you to a bear claw donut. But that's how incompetent this Fed was. They had no idea how construction loans work. They didn't understand an interest reserve. They didn't understand why commercial real estate was going to blow up. And I was the only one. And if I hadn't been there, that dot would not have been connected probably for another 2 years. Wow. The whole would have been worse. And that's what scares me right now, is that the Federal Reserve influences the type assets that a bank has to hold. So Silicon Valley Bank was built on a business model, high risk, fund all the venture capital in the world, all these high risk businesses that could crash and burn at any time. So the San Francisco Fed said to Silicon Valley Bank, you need to hold really safe liquid assets. And the bank said, okay, what are those? Oh, well, 10-year treasuries. They're very liquid. They're very safe. So they load up on 10-year treasuries that then have to be marked to market and aren't worth a damn thing. The Fed created the whole damn problem in Silicon Valley Bank, and we don't let one industry or one company be financed by one bank.
You and I grew up not having to pay for a movie ticket.
Oh, and I didn't even remember that one.
Yeah. We grew up being able to eat at Great Harvest Bread Company whenever we wanted, for the most part.
Free.
For free. Same with Papa Murphy's. We can go pick up a pizza at any moment for free. We just put it on the Barron account. So yeah, we're going to talk about how and why that was possible.
Yeah.
Through creative negotiating.
Yep, that's a good way to put it, through creative negotiation.
Whatever we're about to get into, if I'm your friend and you're doing a commercial deal, I'm a residential agent. Would I know as a residential agent that this is not my lane?
Maybe not. Well, here's the thing. I don't fault them for wanting to do it. Those can be lucrative deals. You know, they're trying to continue to build a relationship with probably somebody that they grew up with, or they've already sold them a house or two. They've got a relationship already, and now they've got an opportunity to do something else, generate a fee. Like, I don't fault them for wanting to do that.
Mm-hmm.
The problem is they're wading into this space where they're lacking a lot of the information that you need to do a great job for somebody. So you got these 4 feasibility tests. And the idea is any deal you're looking at, any market you're looking at some point you got to decide, am I going to do it or am I not? And this model gives you a way to, hey, let's test this deal 4 different ways with these 4 feasibility tests. And if they check out, then say coast is clear, let's do the deal.
Oh, okay.
If they don't, if it fails any of these, might not want to do it. It allows you to kind of go through a process and not have to worry so much about what am I forgetting to consider. So here's these 4 feasibility tests. First one is market and competitive analysis. It's the idea that you're going to look around and see what other competing properties are there, what's the market look like in general, and what assumptions can I make that based on these market conditions, based on the competition, if I do this deal, I can expect to get this kind of rents. If I do this deal, I'm probably going to have similar results. Or I'm at least dealing in that market.
Like something that most people would be familiar with is on Zillow. It gives you the estimated, like it could show you the estimated.
The Zestimate, right?
Yes,
Is that what they
the
call it?
Zestimate. And that's based on the market right now. So it could show you the value of your house today.
When I go into a market and I look at it for self-storage, I make a list of all the self-storage facilities. Where are they? What are their websites? What are their rents? What size units do they have? What's their vacancy or what's their occupancy, phone numbers, website? Like, we're just looking at everything else in the market and saying, what kind of rents are they getting? How full are they? Are they mom and pop, or are they, one of the big 5? So we're just trying to figure out what's going on there. So we have market and competitive analysis. The next one is location and site. This is where we look at the site itself and say, look, do we have any issues here? Do we have enough parking? Do we, for the use that we would do? If it's a ground up development, what kind of site work am I going to have to do? I'm looking at the site and I'm analyzing it itself. I had a deal in Columbia that we let go because we failed the location and site feasibility test.
Yeah, okay.
And I'll tell that story here in a minute. The third one is political and legal. Here, you're asking the question, will they let me? Am I allowed to do what I want to do here?
So where you would look at zoning, yeah, a business code,
Deed
or a building code.
restrictions, all kinds of different stuff. Yeah.
The master plan.
Yes, we might look at the master plan. These are all the things that could derail you. Will they let me? Somebody else has some rules out there
Might be the master plan, might be zoning stuff. There are communities that don't want self-storage. They don't think it's pretty. Well, it's not pretty. And they just don't want it. Like Brentwood, Tennessee, Franklin, Tennessee, it's hard to get self-storage development done there because they just don't want a lot of that around.
Yeah. Let's make it pretty. That'd be innovative. This would be an idea for me to work on. Pretty self-storage.
Let me know what you come up with there.
Pink. That's all I got now. Pink.
So politically, so we got competitive and market and competitive analysis,
Location, site.
political and legal. And the last one is financial feasibility. Like, will it make money? So I'm going to make some projections. I'm going to underwrite it. I'm going to see if I can make it make money on paper. If you cannot make it make money on paper, you can't make it make money in real life.
What are you teaching me today?
Today, we're going to talk about leases.
Yay.
And so if you're a commercial real estate investor, what you're buying is the cash flow that a property creates. Commercial real estate in a lot of ways is built upon leases. So what I thought I'd do is I'm just going to throw some lease terms at you.
Yes.
And see, what do you think these things mean?
Yeah, no, I know. I'll tell you what they mean.
Okay, what is land lease?
That's when there is a piece of land and you kind of lay down in it like you would a fleece blanket and soak up the sun. You'd be land leasing.
No. Okay. What about a termination option?
You could go with the lease, or you could have Arnold Schwarzenegger come in and blow it up.
Okay. No. What about holdover?
Holdover. This is something that a lot of spouses do to the other one if they make a mistake and they use it as leverage.
You're not wrong, but what about exclusivity?
Exclusivity. Oh, this one's easy. It's like the VIP tickets. No one else is allowed to go into this building without your permission.
Okay, you're not way off on that one. What about tenant improvement allowance?
So I guess I could explain it in this way. When you're a kid, your parents are trying to get you to do chores and do things. They'll give you an allowance to improve your behavior. With this, it's the same thing, but you're doing that with your tenants.
So no,
Okay.
not at all. What about quiet enjoyment?
That's when you kick back, put your feet up, take your shoes off, sip a coffee, a tea, whatever you prefer, and you've got your kids locked in the back room.
That's not it. Mitigation.
Mitigation is easy. Describing it in layman's terms is a little difficult.
All right, next one, counterparts.
So it's like a table. You want to put it together. You take your counterparts and, duct tape or super glue.
Okay.
Then you got a table or counter.
Mm-hmm. No, what about estoppel certificates?
It's when you're trying to stop people from doing anything, those people, you'd call them stoppels. And if you really want them to get out, you give them something like a certificate. And that's what we call stoppel certificates. They think they won something, but no, you got them to quit whatever they were doing.
No. Okay, here's the last one we'll do, and then we'll get into what some of these actually mean.
Great.
Indemnification.
Oh, that's when you verify that somebody is dumb.
Is that what we're doing here today?
Yeah, I think so.
Okay.
What are you teaching me now? What are we talking about now? What are we doing right now?
Man, I thought we would just talk about how you can use ChatGPT in commercial real estate and just in general. And I thought I would start off with how we used it in kind of a funny way. Well, my top producer, Todd Humphreys, he gets this email asking for more information on a piece of property. So he sends them information, and then he gets this email and says, "Thank you for the email." No punctuation there. Next paragraph, "Kindly proceed and draft the offer. I'm presently residing in Hong Kong, and my investment broker is on standby to issue payment as soon as documents are reviewed and signed. I would like to settle all the upfront and full payment via a lawyer that is vast in business purchase dealing prior to the closing of the purchase. Hence, I will solicit your help in helping to get a reputable firm within your jurisdiction to help out with the escrow. Please stay safe out there. Regards, Mr. Wong."
Yeah.
Okay, so we get an email like this, and Todd forwards it to me, and all he says are two words: good grief. So I thought, man, what would happen if I got ChatGPT to send me or to create for me an email response that will at least waste this knucklehead's time? Here's my prompt. I'm wanting to waste the time of an internet spammer who is posing as a Chinese businessman and wanting us to write an offer on some real estate we have listed for sale. Will you write me an email response that sounds somewhat legitimate but is full of craziness? I want this person to read the email and be somewhat confused but also intrigued. Or here's what it gave me. Dear esteemed business partner, I'm incredibly delighted to have received your proposition regarding the real estate we currently have listed. Your inquiry has risen amongst many like a giraffe in a field of zebras, an event and as usual as a camel on a surfboard. To give an offer, I must consult with my board of directors. Interestingly, our board includes Mr. Roberto, a retired Italian opera singer, and Miss Penelope, a renowned culinary wizard known for her tuna fish lasagna. Both individuals, while exceptionally talented in their respected fields, are regrettably inexperienced in real estate. Yet they are fiercely determined to understand the intricacies of this deal, demonstrating a dedication that could outshine a solar-powered flashlight.
Whoa.
That's outshining right there.
Yeah.
Moreover, the process could take slightly longer than anticipated as our decision-making process involves a rather unconventional method. We usually meet under the oldest willow tree in the city park at the stroke of midnight, where the moon's illumination facilitates our discussions. When a decision is reached, we notify the swans in the adjacent pond. Their honks are considered an affirmation of our decision, and only then can we proceed. We would appreciate it if you could explain why you favor our real estate over the moon's real estate. We've heard lunar property is all the rage these days. In addition, we usually require potential partners to answer the following question. As a sign of their commitment, if a woodchuck could chuck wood, how much wood would a woodchuck chuck?
Great question.
We understand that our process might appear unconventional, but we believe in the wisdom of the unique and unusual. We look forward to hearing your response and progressing our lunar dreams together with the utmost enthusiasm. So before I get into any more of this, tell me from your experience, how would you even describe what ChatGPT is?
Years ago, I'm in an Marcus and Millichap conference room with my peers, and we're talking about A, B, and C assets, and this completely hilarious Armenian guy stands up and he goes, Eric, I do not understand what this A, B, and C property classification you refer to is. And I'm like, all right, Kirk. So A grade property or A grade neighborhood is like where you hope to live someday. Maybe you do now, but that's where everybody wants to live. B grade is probably somewhere where you do live now. You can walk around at night and it's relatively safe. C grade neighborhoods are where before you get out to take pictures, to do a listing proposal, you're kind of going to look around the sides of the car and down the street and see who might be there. And then D-grade neighborhoods, which we do have here, those are the ones when you do the pictures for the proposal, they're a little blurry because you're taking them as you drive by the property because you're not going to stop or get out. And certainly in the C and D neighborhood areas, you want to visit those properties between 9 and 11 in the morning when the bad guys are still asleep.
And today we're going to talk about how to work with a commercial real estate broker. We're also going to talk about different types of clients. Some you want to be, some you might want to avoid being. Why don't we talk about some categories of different types of clients? And I bet the rest of this conversation will probably flow from there. You've got these folks that are advice seekers. I had one of these guys call me yesterday. Now, no issue with advice seekers at all. This guy is a former client. Shouldn't even call him a former client. I fully expect to do more business with him. But he called and he had a quick question. The other side of that spectrum, though, are the takers. Takers are these people who come in under the guise of, we're evaluating if we want to hire you. So they're putting me in a position where I need to demonstrate my expertise. I need to give them good value, good information up front in trying to win their business. But what they really do is they're just taking. They have no inclination whatsoever to actually hire us. They just want to get our expertise under false premise and then try to go do it themselves. We also have those who are close to the vest or just the untrusting type of client. These are the folks who don't really tell us what's going on, and they might give us some parameters, but they don't tell us what they're actually trying to accomplish. Next one are the hound dogs. The hound dogs are the clients that just want to date all the brokers. They want to talk to all of us. They want to take us all out to dinner, not at the same time. Another type of clients are the cheap ones,
Cheapies.
and trying to pay discounted fees. This happened to me yesterday. There is also your great clients. They let us in, they understand the goals, and then they let us go do our job.
Yeah.
A lot of clients make a big mistake. They'll hire us, and then they continue to work alongside of us, almost in competition with us. I had a client one time, and this has happened a number of times. They'll come to us. They've tried to lease their property or sell their property themselves. They have not succeeded, and then they'll like give up. Fine, I'm going to hire a broker. And right before we're about to sign a listing agreement, they'll say, hey, look, we've talked to these 6 people already, and so we want to exclude them from the listing agreement. So if those, say, 6 people come and buy or lease this space, you don't own your fee. Now, this creates a big problem for the client relationship. As soon as I agree to an exclusive like that, I am now not aligned with my client anymore. I'm actually in competition. I need to go get a deal done before he does a deal with one of these people.
Let's jump into talking about quarterly market reports.
Yeah, okay. What we're going to do here is we're going to take a look at the national economy, then get into Owensboro, and then I'm going to show you retail, industrial, office, and multifamily at a high level. Timmy, do you remember when we talked about CRE when we had Casey Conway on?
Yeah.
He was one of the creators of the CRE index.
This was the thing that he was really wanting the Federal Reserve to look at. This is the information that is forward-looking. You
And
all
our
are
goal
looking.
was to see if we could find just 10 simple indicators that all look out the window, put them together in an algorithm that's very predictive. So we did that, and you can go to sitetodobusiness.com/CREPI, C-R-E-P-I, and it's all free and it's all transparent, unlike the Fed. And so we back tested it back to the last century, and we never missed a downturn or an uptick in the market.
It would have given an indication that the Great Recession was coming. It's giving us context to where we are as a national economy. But here's what you got to remember. Real estate is local. So you need to understand the national context and then understand the local market, because it may tell a different story.
All right. What you teaching me?
What I want to discuss at this point, or teach you, is a little bit about gap analysis. The whole concept of gap analysis is try to figure out if there's a gap in a market. Like, is there an opportunity to do something here? So if you run a gap analysis, you might find there's going to be a lot more demand for housing than there are housing units. So you might expect in the future a lot more households than there are housing units. So that might say, and this is an opportunity for somebody to build. But you handle the gap analysis differently in each one of these different 4 major food groups. So when it comes to office space, traditionally, and I say traditionally because this has changed wildly since COVID, is you would say how much office space is in a market and how many employees are there that use office space, and you would divide and you would figure out, okay, there's 213 square feet per employee on average in this market. And so if you see job growth coming and you can figure out how many of those new jobs would potentially use office, you multiply that by 213, and that could give you a picture of the demand that's coming, and that might show you an opportunity. Or you could look at a market and say, there's way more office space here than there needs to be.
Bo, what are we doing today?
This is the first, hopefully, of a series of episodes that we'll do periodically where we take listener questions and address them. And we're paying attention.
Yes, we are. Kelly Burke asks, thank you. How do I find those classes? You know what she's referring to?
Yeah, she was asking about how does a residential agent transition to the commercial side? And we answered that question on a previous episode. Essentially, connect with a team who's doing commercial deals and get experience on as many transactions as possible, as quickly as possible. And the other thing was to educate yourself. And I would recommend the CCIM education. That's what I did. It was huge for me. My confidence level, fantastic, best in the industry education. And to find out about those classes, you simply go to ccim.com and click on the education tab. And you can search, it'll take you through, like if you want to earn the designation, you take these classes. But more than that, they also have Word Center courses, which are online bite-sized courses. So they might be 4 hours long. And you take them over the course of 2 days, 2 hours each kind of class. And it might be on a very specific topic that you're interested in. There's dozens and dozens of courses like that you can take a couple $100 each, do it online. It's a great resource for the industry, especially people from the residential side that are interested in learning more about how to do commercial deals and maybe transition over to commercial. That's what I would recommend.
Yeah.
You can go all out and get the designation. I teach one of those courses. I love it. I recommend it to anybody. But if you just want some bite-sized stuff, that's available there as well. And you can do all that online. You want to talk about money?
Let's talk about some money. Yeah, let's talk money.
Does that give you a hit of dopamine?
It sure does.
Well, I thought what we talk about today is a deal that we just recently completed. But I think if we take people through this process, that it will help people think and look differently at property and maybe find some opportunities in their markets that could be similar to this. If nothing else, it will plant some ideas in some folks' heads about how deals can get done.
Who are we talking to?
Investors. Now, I'll tell you though, if there's a small business out there that would like to buy something for their own business, that's essentially what I did here.
What are you teaching me today?
We're going to talk about mistakes that investors make. Yes. I think I've got 11 of them, and there's some overlap here. Mm-hmm. The first one is people get fixated on price. We have Dr. Jeff Engelstadt, CCIM, here with us today, which I'm really excited about. He's a CCIM instructor with me. We've had some episodes where we've talked about syndications. I gave you the pitch deck episode. Jeff has done many of these, and he's been the guy on the general partner side, kind of the sponsor side, and more recently, as we've talked over the last couple of weeks, he's been more on the limited partner side, where he's more of the investor than the guy who's running the deal. And so what he thought we'd talk about today are some of the differences, the pros and cons, the different profiles of somebody who might fit more as a GP or a general partner versus a limited partner, and kind of how he's transitioned from one to another. We have my buddy Brad Arns.
I know, you told me.
Well, what'd you ask for?
That's what I asked for.
You specialize in what you know. You think about how many owners out there, investors out there are like, oh, it's just a broker. But as a, former broker, other brokers, like, you have no idea how hard we work to gain your trust. And on the flip side, to buy a deal, brokers have no idea how hard it is to actually underwrite, due diligence, and close and manage that deal start to finish.
And I don't think I've ever really thought about this before, but I knew that stuff because I watched our dad do it. And so even though when I came into the business in 2004, I was brokerage, pure brokerage, but the company managed the properties. I watched Dad look at deals. I watched him buy some things. I watched him invest. I got to see that and kind of ride shotgun on a lot of that stuff. And I've never really thought about how potentially unique that is. We've got my friend from Austin, Texas, Robbie Eads. Robbie and you, I think, have a lot in common. You're both in the ADHD camp. Mm-hmm. Dude's a big walking smile. And so I'm really excited to have him on the show. So Robbie, welcome, man.
Hey, thanks for having me, guys.
I've been excited about this episode. Get you two knuckleheads together. What is a Texas turkey vulture?
There you go.
Oh, there it is. Texas turkey vulture. Very attractive bird.
Yeah.
I bet it looked great on fire, too. Holy moly.
Isn't that neat?
Delicious.
Today we're going to talk about market cycles. Demand, especially in real estate, demand is driven by people. In commercial real estate, supply lags demand. I mean, it can take years to create the supply to meet the demand. And because of that, it causes these market cycles. I'm going to show you Dr. Miller's model. You've essentially got 4 quadrants. You have recovery, expansion, hypersupply, and recession. That dividing line horizontally is the long-term occupancy of that market. This point number 11 has this vertical line here. Point number 11 is equilibrium, and this is the magical moment where supply meets demand. If you have more demand than you have supply, you're on the left side. You're either in phase 1 or phase 2. If you have more
supply than you have demand, you're in either hypersupply or recession. So this is how this is broken out into the quadrants. Phase one of the market cycle, this is the recovery phase. Demand is starting to increase, but it hasn't increased enough to drive rents up enough to where it makes sense to build any new supply. Your occupancy rate is building up to the point where you have reached the long-term occupancy average for whatever market you're in. Once that happens, that starts phase two of expansion. At point 8, rents have risen enough to where it is now profitable to build new supply. And as these developers start delivering their new supply to the market, well, you'll get to 11. You've reached equilibrium. But the market, in my opinion, stays there for about this long. What happens is, and this happens every time in every market cycle, developers always overbuild. But people still have to finish these projects, which just continues to provide more supply. Your occupancy rates are starting to fall back down to that long-term average. And there's still new construction happening. They'll finish those projects all the way into phase 4 recession. And it gets down to that point 1. And that point 1 is the same in phase 4 as it is in phase 1. That's the bottom of the market. So yeah, if you understand where you are, you might be able to get in front of everybody else. When you hit point 1 at the very end of recession, that's also the very beginning point of recovery. And there are all kinds of people in the commercial real estate industry right now that got in after 2010, 2011. And if that's true of you listening right now, and this is your first down market, you really need to hear this. There's always a recovery after.
We're doing a Q&A, a little mini Q&A. I've got 3 questions for you. One of them, we're going to be looking at some stuff.
Okay.
Are you ready? What is important to look for or think about when looking for an investment property? And I think we could do a whole episode on this too, but
We probably could, but that's a great question.
yeah.
There's a couple things to think about. One is, like, how involved do you want to be when you own it? So buying it's one thing, but after you buy it, now you own it, and it's your responsibility. So how involved do you want to be in the management of what you're going to buy? And there's a big spectrum. So imagine you buy a 40-unit apartment complex. Yeah. Got it? Okay. So 40-unit apartment complex.
Where were you at there? No, I'm kidding.
There's 40 potential tenants who have your number as the owner, and when the refrigerator breaks or the toilet gets stopped up or whatever, they're calling you. Do you want that amount of work? All right. If not, you can hire a property management company to take that all off your plate. You're going to pay them to do it. But something like a multifamily investment, if you're going to buy apartments, that's pretty management intensive. You need to be ready to do it yourself, or you need to be ready to hire a property management company to do it for you. On the other end of the spectrum, if you buy a warehouse that's leased to one single tenant on a triple net basis, you remember what triple net means?
Yes. The expenses pass on to the tenant.
Yes. Okay. So essentially, pass through is more, but yeah, they pass on to them, pass through. But in this scenario, if the roof starts to leak, the tenant will just fix it. In a true triple net lease, HVAC goes out, tenant's responsibility. Grass getting mowed, tenant's responsibility. And so an owner of that type of property has very, very little management once they own it. We had a woman one time who was selling a portfolio of single family rentals. And so she had a bunch of single houses, and her income was variable. She got a lot of maintenance calls, and she wanted to simplify her life and travel more. So we helped her sell that portfolio and then buy single tenant net lease properties, more like the other example.
Right.
So that she knew exactly what her rent was going to be, and whatever happened to the property was the tenant's responsibility. So it just totally simplified her life. The other thing is, like, what do you like? You may find that you really like apartments, or you really like retail properties. And so you would just prefer to own one of those versus a different property type. That would be something to look at. Another is just the numbers of the deal. If you're going to buy something that's more on the non-management mailbox money side, where you have no responsibilities, you're going to pay more for those, and you're going to get less of a return. It's more stable. It's less risky. Therefore, you're going to get less of a return on your investment. So if you want stability, you can still make a pretty good return over here, but it's going to be less than if you buy something like we're looking at a deal right now. If we buy it, we're going to spend a significant amount of money and work and time, probably over the first year to 18 months, stabilizing the property.
Right.
It's going to be a lot of work, and it's going to be a lot of money on the front end. Once we get it stabilized, it should be a great deal. And for that amount of work and that amount of risk, I expect a higher return than I would for something on the other side that's just more mailbox money. So what are your investment goals? Are you trying to make 8% return on your money? Are you looking for 15%, 20% or more?
Which would be double?
15% over 5 years, you're going to double your money just about every 5 years. Yeah,
right.
15. Thank you, Dr. Jeff.
Yeah, thank you, Dr. Jeff. I didn't have to do math, just memorize what he said.
That's right. So those are some of the things. Another thing to look at is geography. I think most of what we own is very close to me. Some of that is because, this is where we find opportunities. I know this market better than any other. I'm very comfortable here. But, some people want to diversify geographically speaking. And so that's something to consider as well. But, I would say for somebody who's investing for the first time in commercial real estate, the amount of involvement you want once you own it is probably the first and biggest question to answer.
Okay. Can I throw something at you then?
Yes.
Okay. Here's a scenario.
Okay.
I am in that spot that I described before. I got some money. I want to do something with it. I'm not interested in commercial real estate per se, but I am interested in putting my money in commercial real estate.
Did you just say I'm not interested in commercial real estate, but I do want to put my money in commercial real estate?
Yeah. Can I explain that?
Yeah, because I don't understand.
Yeah. So when you put together syndication deals, you're going to a doctor or a lawyer or somebody that may not be interested in commercial real estate, but they're interested in investing in commercial real estate. Do you see the difference?
Yeah.
So I guess the succinct question is, what's the most passive way to do it? And if I wanted to throw my name in the hat to you, to be like, I know Bo, right? Or I'm listening to this podcast, I got some money. How would I throw my ring in the hat? So when you have an investment deal come up, how can I contact you? How can I throw my name
hat in the ring?
Yeah. How can I throw my hat in the ring? Name in the hat? Hat in
the ring in the hat.
Right. So, yeah. And if I don't know somebody like you, two different scenarios. I know you. How do I throw my hat in the ring? And the other one is, I want to throw my hat in some ring. How do I find that ring?
Yeah. So if you know me or somebody like me who will put these group investments together and you want to take a look at the next deal that I do or somebody likes me, just say, hey, next time you put a deal together, I'd love to take a look at it. I mean, that's all it is. Because at that point, we're going to start vetting each other, right? So you're gonna look at me and my track record. Can Bo do what he says he does? Does he have a track record where he makes his partners money, et cetera, et cetera? You got to get comfortable with me, because that is probably the most passive way to invest in a deal, is you give it to somebody who's good at this and you trust them to make you money.
Right.
And you can drive by and say, okay, that property right there, I want a piece of that. I'm an owner. But you have no responsibility and no authority. Right? You're literally just trusting the guy running the deal. Now, on the flip side, if I'm the guy running the deal, I need to make sure you fit the profile of a good investor, that you're comfortable with the idea that you have no responsibility and no authority.
And you could watch this episode to figure out the different types of investors or kinds of investors, what not to be.
Yeah, we've talked about that before.
Yeah.
If you want to find people like me, then, and I might just start with a Google search, and you could say, search for general partners, syndicators, sponsors of group investment deals, and just see what you can find. There's lots of people who do this in just about every market.
Yeah.
And so it would just be, and if you're connected in that market at all, you can probably just ask around. call a real estate attorney in your town. They're going to know who that is. And then, just do the normal soft skill stuff of finding somebody, making an introduction, and building a relationship.
Yeah. On average, because I know this is different every time, but on average, how much or how little can I put in? Like, what can I expect if this is my first time? Can I throw $10,000, throw my hat in the ring with you, and be like, hey, I got $10,000 I can throw in? Is that too little? Like, on average, what?
Most deals have a minimum investment. So the last two that we did, I think the minimum investment was $50,000. Now, that's the way I do a deal, where I'm trying to take a relatively small amount of people, raise a relatively significant amount of money. So, if I took $10,000 a pop, I'm going to have a lot of people to manage in the group. So I try to keep things pretty small. I think the average investor in our last deal put in $100,000.
Oh, okay.
So, but there are also real estate investment trusts, or REITs. We essentially buy stock in a fund.
Oh, yeah.
And you can do it at much smaller increments.
Right.
You might have a fund that specializes in, self-storage properties, like Public Storage is a REIT. They're the world's largest self-storage owners, and you can buy in to, these REITs and invest smaller amounts of money. Essentially like buying into a mutual fund.
Right.
But the fund itself is investing in real estate as opposed to, different stocks and different companies like that. But,
okay, cool.
Yeah.
Cool. There you go, Katie.
What are you teaching me today?
We've got a guest, right? Scott Overby, CCIM from Jackson, Mississippi, although he says he's in Oxford today.
So I love the dad stories, and Bo being in the business, taking over the family business. That's similar, to us reopening my mother's company, taking a little different direction. You get so many great wisdom and insight things on business. What were the key things that your father ever, that you take with you on every deal you do?
That's a great question. Great question.
Here's the first thing that happened when I got out of the military, started working with my dad. I remember he had just put together 8 or 9 parcels for a Walmart deal. And so Walmart had closed on those. And one of the people who owned the parcels there, they were supposed to get $150,000 an acre or something like that. Walmart paid them $150,000. They had an acre, 1.2 acres. And so they were due another 30 grand or whatever. They probably just made a mistake. Let's just go with that.
Yeah.
We didn't catch it on the closing statement. Nobody caught it. The attorneys didn't catch it. And so the people come back after kind of reading after the closing, and they're like, Walmart owes us another 30 grand. And so my dad goes to work on it, and he can't get Walmart really to do anything. To them, it's a done deal. My dad brings these folks into the office, and this was literally the week I got back. And for pretty much the first 2 years I was working with Dad, I would be in on all his meetings, and I'm just picking up whatever I could. And this was one of, if not the first meeting. And he told these people, he said, look, I can't get Walmart to do anything about this. And even though I think blame can go around to everybody who was involved in this, I'm going to give you my fee on the deal. And so he took his commission and he gave it to these people. Now, it didn't make them whole. It was what the company would have made off that. Now it went back to them. And I just remember, huge impression on me. I was like, okay, I grew up with a dad who would do the right thing.
Yeah.
And he would tell us, you do the right thing for the right reasons. Even if it's for the wrong reason, you do the right thing because it's the right thing to do. But the very first thing I saw him do was the right thing. He put the reputation of our company, his integrity, his relationship with these folks. He put all of those things before making a dollar.
Whenever you hop off of here, just leave the tab open.
Pay no attention to what happens in the background in the meantime.
Yeah, sure. You can leave. We won't watch you.
Yeah, no problem.
Enjoy it, guys. We'll see you later.
Thanks,
See you,
man.
Scott.
Talk soon.
Bye.
subscribe. If you know anybody else that's into commercial real estate, please share this. Write a review on wherever you listen to the podcast. It just helps in this world here. Thanks for watching.
Good.
Cool. Bye.
Bye.
Bye, Alice.